Good afternoon. I'd like to, I'm Augie Che from the class of 1991. I'm the reunion chair and a co-chair of my class, 1991, with Dan Simkowitz. I don't see Dan, great. Today, first and foremost, I'd like to thank a few people. I'd like to thank the Dean Glenn for allowing me to participate in this reunion in this way. I'm very proud and honored to represent the school and the class in this centennial reunion. I also like to thank the staff members who have been working. You know, we started planning a while back, so Liz, Tanya, Matt, everybody here and all the people I haven't named, we made it. Also, I'd like to thank some of you. I've been working with some of you over the past several months on calling people up, making sure that we reconnect with people. So the various class chairs and the reunion committee, I'd like to say a word about that. I thought that we made it and we got to this point as great as a breath of relief. But what I found is that I think over the past few days is that this is a beginning. I really enjoyed, and we're talking. Some of us are talking about meeting up in Asia, in Balisin, in Hong Kong. This is a great part for me. The classes that we took, for me, it was 27 years ago. They were a good part. They were the past, and then this is the present. But as I think about the past couple years, the school have asked me to, when I travel to different places, meet up with a few folks. So I don't see Ross Youngman. As some of you heard the stories before, Paul Rankin here will know, that because we were talking about the stories the past couple of days ago when Ross and I were just sitting in the Sydney Harbour, right across, and he pointed out, this is Nicole Kidman's house, used to be, and I used to swim right here. And we're just having breakfast in a beautiful sunny day. I was with Neil in Dublin. I tend to fly in and fly out of Dublin for board meetings, and I can tell you, I'm doing this family cookbook that some of you might know, and that Irish stool inspired me to create my own. And you probably know, if you talk to 10 Irish families, they probably have 15 different Irish stew recipes. My secret, and I'm telling you, and I'm not telling anybody else, it's going to be just for my kids, is white pepper. Seriously. I don't let anybody tell you anything else. It's, barley is this, and then no, white pepper. And this morning, some of us were on top of the Mandarin Hotel. We were enjoying ourselves, a great breakfast. We have Angeline and we have Felix right there, over there. If you don't know the fish dish, we also have Marvin and Stella Levy, and we were just talking about life, talking about kids, talking about school. Their school now, not ours. But anyway, so those are the moments that I'll encourage you, because my life now is so much more because of the business school, because of that. So hopefully this will be reunion, not as just one point in time, but a beginning of another adventure and the beginning of something. And without further ado, it is my pleasure to introduce this session, the current economic crisis, where next I'm delighted to introduce Bruce Greenwald, the Robert Helbring Professor of Asset Management and Finance and the co-director of the Helbring Center of Graham and Dodd Investing. Also, Joseph Stiglitz on my left-hand side, Executive Director and co-founder of the Initiative for Policy Dialogue and University Professor of Finance and Economics. And last and not least, moderator, Dean Glenn Hubbard, the Russell and Clark Carson Professor of Finance and Economics. All of those you can read in this. I hope everybody picked up one on their way in. Kindly note that today's session, as I was reminded by Matt over there that this is being live streamed in real time to Reunion Year alum around the world. So hello, everyone. And I'd like to extend a welcome to our everyone here as well as our remote audience. I was also told that this discussion is being videotaped. Great. So that it will be posted on the Reunion website after the weekend. So with that, I'll leave the floor to you, Glenn.
Thank you, Augie, and thanks again to people who are watching this remote here or around the world with alumni. It is a real treat to have this panel. One doesn't really moderate Bruce and Joe. I'm sort of in between them. I'm going to try to steer some questions, but I think we're really fortunate. I can truly say that Joe Stiglitz was one of my teachers, really, in economics and in public economics, and is a giant, of course, in the field. Bruce Greenwald has been a colleague and friend for decades, and one of the first things I did when I got to Columbia was try to recruit my friend from Bell Labs, Bruce Greenwald, and it is probably the single biggest contribution to value I've ever made in my decades here. So we have a big subject, which is the financial crisis in the economy. We obviously can't cover all of that, so I'm just going to foreshadow what I am going to talk to these guys about. One is about sources of the financial crisis. One is about whether monetary policy has been effective in the crisis. And one is on the rise of populism. And then closing out a discussion with them about practical solutions that we could implement to get us in a better place. So let me start with the financial crisis. Bruce, a lot of people think the financial crisis really is kind of a lightning bolt. It's Lehman's failure or something like that. But many economists also think there are long-term structural problems, and the financial crisis is a culmination, if you will, of those. Try to help us through that.
Okay, that's a setup. The financial crisis is a symptom that if it had not been for Lehman Brothers, if it had not been for the mortgages, if it had not been for the housing bubble, if it had not been for the fact that in 2005 on, the bottom 80% of U.S. households were spending 110% of their income, which they were financing with housing. If it had not been for the internet bubble, this is a situation that would have arisen many years earlier. That there is a fundamental, long-lived problem at work here. And it's actually strikingly similar, although for reasons I hope we're going to talk about, not nearly as bad as the Depression. So if you'll indulge me, I'll talk about the Depression first, and then I'll talk about what I think is going on and how you better keep a room for your children for the next 35 years.
Please don't say that.
So if you think about the Depression, it is not like a normal business cycle, and it is not driven by the stock market crash. Financial crashes have a well-developed symptomology. The firms produce at a certain level. There's a shock to demand. They accumulate inventory inadvertently. They accumulate capacity inadvertently because they don't adjust immediately. They have to finance it with debt because you can't sell equity for informational reasons in financial markets. Their balance sheets deteriorate. There's a short, sharp cutback that's typically 6 to 9 months. And then, again, because they can't sell equity, there's a long, slow recovery. The Depression looks nothing like that. The second half of 29 is bad. 1930 is bad. 1931 is terrible. 1932 is bad. And the first part of 1933 is bad. There is a huge structural problem here. And what the problem seems to be associated with is agriculture dies. That the balance sheets of farms have been deteriorating over the 20s because farm productivity is growing at 5 to 7% a year, and there's only so much food we can eat as much as we're trying to do it today. And agricultural prices collapse, and people, by the way, are a third of the U.S. population, are trapped in these farm communities because once the balance sheets are undermined and all their assets are in farming, they can't afford to move because they can't borrow. So they stay there, productivity continues to grow, they continue to drive down farm prices, that because their purchasing power dies, and by the way, agricultural incomes fall by 80% in the Depression, they bring down the urban economy with them. And there really is no solution. I mean, the standard Keynesian solution, which is you give credit to the war, is probably not what's going on, because the great Keynesians at the time are running around saying the Depression is coming back after 1945. But what seems to have happened is, inadvertently, the war is extremely successful industrial policy. It gets everybody off the farms at the government expense, either into the war factories or into the army, and then through the GI Bill into the cities. And the countries that don't participate in the war, like Argentina, never recover from the Depression. Well, what seems to be going on today is that manufacturing is dying. And it's dying for the same no-villain reason that agriculture died. Productivity growth is 5 to 7% a year, and global demand growth is maybe 3% a year at most. And at the same time, you've got this huge increase in manufacturing capacity from China and other Asian countries. And what does that do? It means that people have got to shift out of a sector they're not interested in shifting out of. And they do, again, what they did in the Depression. They try and export their way out of the problem. So in the Depression, Argentina and Australia devalue early and they recover. They do sell their agricultural products overseas, but the problem is, when you add up overall countries, the surpluses and the deficits have to be zero. So China, Japan, Germany, for various reasons, are able to control their currencies, and they're able to try and export their way out of the problem. But when you add up overall countries, somebody's got to eat those surpluses. And ultimately, it became the United States. So we had this massive 7% of GDP deficit on current account. And we had to make that up somehow. Now, there is a natural thing that helps, which is when they run these surpluses, sad to say for them, they have to accumulate dollars. And they have to invest those dollars back in the United States in some form. And that drives down U.S. interest rates. And it drives up these, or creates these financial bubbles that help offset, through excess consumer demand and so on, the chronic deflationary pressure from the collapse of manufacturing. And you will notice that nobody is trying to shift out of it. And it's finally catching up with the Chinese and the other people. So that's the first big problem, that everybody is putting all these resources into a dying sector. The second big problem is that they're trying to sell the output of a dying sector. And by the way, exports are going to disappear, because as manufacturing productivity grows, the value of cheap labor in the emerging market shrinks. So when GM got in trouble in 1980, they had 360,000 workers. Today, they're under 30,000, and they're heading probably under 10,000. And the value of cheap labor in the emerging markets is not going to be enough. All the manufacturing jobs are going to come back to the U.S., and that's going to create huge problems for development. So there are these enormous imbalanced problems out there that are not going to be easy to solve, but there is good news, and I'll leave on this note. And it's good news for the people in this room, but not, as I say, for your children, unless they get to come to Columbia Business School. Service businesses are local businesses. They're not big, globally competitive businesses like manufacturing. Local businesses can be dominated by local companies. That means that if they have local economies of scale, they can create barriers to entry, and they make extraordinary profits. And one of the things you've seen is that profits have gone from about 8.5% of national income in 1990, as this transition to services has actually taken place in the United States, to about 14% of national income today. In addition to that, because management is crucially important in these decentralized service businesses, your incomes have done extremely well over this period, and they're going to continue to do so. But for non-highly professional trained managers, service jobs are actually a lot less remunerative than manufacturing jobs. So ultimately, what helped the transition out of the Depression was that there were high-income manufacturing jobs. In services, that's not going on. So you've got these very adverse trends in the distribution of income, and what it means is that consumer demand, because the high-income people are high savers, is also depressed. So that you've got chronic deflationary pressure, pockets of prosperity, and nobody really thinking about that structural problem.
But it's not just not thinking. Aren't politicians actively making it worse? So you have the Tata Sons steel issue in Britain. You have people promising the American people are going to revive manufacturing. I mean, how do we get a different tone?
Joe, why don't you talk about it?
I had something else. I'll ask you that. I had something else for you, but he's punted. It's past the parcel up
That's
here.
not my field.
Okay.
Yeah, I think that it's a really difficult political. I can't, problem. The president's saying, manufacturing is dead. All you people in the Midwest get used to it. It's not
a winner, you think?
Not a winner. Not a winner.
Yeah.
So I think it will have to be on a more positive, not that we're going to revive a sector that can't be revived. It has to be, to some extent, macroeconomic policies, and to some extent looking for the alternative sectors. Let me explain what I mean. And before, let me answer an objection that might be raised. Well, isn't Germany successful? Because everybody says, it's a manufacturing economy. Aren't they successful? And Germany's saying to everybody else in Europe, why don't you follow our example? Well, this goes back to what Bruce said about, like I say, the iron law of trade. Economists differ a lot of things, but the sum of the exports have to be equal to the sum of the imports. And Germany simply hasn't understood that not every country can be an exporter so long as our trade to Mars is limited.
Right.
So that if everybody's trying to export, eventually somebody has to be the importer. And if exports are good, imports are bad, and net for the world, it's not a solution. In fact, I think just Germany has done well, partly because it's taken advantage of being part of the euro, which has kept its exchange rate low, which has given it a competitive advantage. And I think they were also a little bit lucky that the particular good that they had a comparative advantage in, the manufacturing sector, was sort of high-end capital goods, which are at the end of China's development strategy. So you begin typically a development strategy, the easy things like textiles, and eventually you get to the high end. But Germany's about to get a wake-up call that strategy isn't going to
work forever.
It's not going to work forever. So what was a critical trick that Germany did? It was an exchange rate. It kept its exchange rate low. So what the macroeconomic policy that could help the United States is a macroeconomic policy to get our exchange rate down relative to others. Now, one way, and again, I'm getting ahead of where we eventually will get to, but keeping a monetary policy at a low interest rate helped our exchange rate so long as Europe was very foolish. So Trichet in 2011 actually increased the interest rate as Europe was going into a deep recession. It's one of the historical, he increased it twice, historical bad judgments in monetary policy. So they're raising interest rates, we're lowering it, that helps our exchange rate. But now they sort of figured it out, and they're lowering their exchange rate. Now they're negative, and we're raising ours. So we're being put at a exchange rate disadvantage. So there has to be another solution, and the global solution that Bruce and I have been advocating is to create a global reserve system.
Yeah, let me come back to that in the context of monetary policy, but let me ask you what I asked Bruce. The financial crisis, do you think it's the product of structural problems? If so, what? Or do you think it was just a financial lightning bolt?
Well, I think I agree totally with Bruce's analysis that underlying this was the structural problem that he described, that we had to make a structural transformation. The markets didn't do it. I think it is also the case that the way you arrive at a non-solution has legacy effects. So our non-solution to getting to the structural transformation that we couldn't get to was to create the housing bubble. And that was a particularly bad way of not solving the problem because it left a very large legacy of debt. Bruce made the reference to the fact that at the end of World War II, everybody thought that we were going to go back into a depression. They said, well, what's changed? What's changed about the world? And Bruce emphasized one aspect. We'd actually made that structural transformation. We moved people from rural to urban. We created the manufacturing capacity. But there was another one, and that was during the war, people built up a lot of assets. There was, we encouraged people to save. There were war bonds. And so they ended the war with a reservoir of savings that then helped fuel the demand for manufacturing goods that made that transition more easily. Now, what we've done is create a legacy of debt. And so that's why, when you say, did the financial sector play any role? I think the particular way that we didn't resolve the crisis, that we kicked the can down the road, has put ourselves for a long while in a difficult position.
But
let me anticipate what Bruce is going to say.
These guys can finish each other's sentences.
That was a good story for maybe 2008, 9, 10, and 11, because we had to deleverage. And now we've gone through that process fairly well. The banks, they're not in perfect shape, but they're in pretty good shape. Balance sheets are pretty good shape. And we are still in what the IMF calls the new mediocre. So it made our, in a sense, the financial crisis distracted us from the underlying problems. And now, 7 years after the crisis, we're coming back to the question, what was the fundamental problem? So, in a way, it gave us something to focus on that was the wrong thing. We should have been focusing on the underlying problem.
But I also think there's a symptom of the imbalance here, which is when we have a big deficit, a lot of dollars go overseas, and they have to be invested back in the United States. And the technical term for that is stupid money. And if you look at where the mortgage crisis starts, it's that all this money drives down interest rates because they start investing in U.S. government securities, and they're not happy with those low returns. So they look for something better, and the people who looked for something better initially were actually the German Landesbanks. And they decided they were going to invest successfully in U.S. mortgages. And when a guy from a small town in Germany decides he's going to do really well on Wall Street knows how to handle that. And it's not going to be pretty. That's what Wall Street does.
Okay. So you're suggesting that when the big Chinese insurance company bought the Waldorf for 30 times EBITDA, that might have been overpriced?
We've done Asia before.
Okay.
Yeah,
Japanese should have learned.
Revival of Japan solution to their surpluses.
So let me change the channel to monetary policy. So in the crisis and after the crisis, we've had, certainly in the States, but in much of the industrial world, the most accommodative monetary policy we've ever had. The recovery is still very subpar by the standards of typical recoveries. Why is that? And would there have been a better tool? Let's start with you, Joe.
So first, let me say there's an important lesson, and it goes back to Bruce's discussion of the Great Depression. Among economists, there is one school of thought that said, if only the Fed had more expansionary policies, we would not have had the Great Depression. He really blames Milton Friedman. Blames the Great Depression on the Fed, And this is being sort of I don't want to say controlled experiment, but it's going the opposite. No one could have had a more expansionary policy. No one could have blown up the balance sheet more. And we didn't have the Great Depression, but we certainly didn't have a strong economy. So I think this really lays to rest that particular theory. The question is, why did all this loose monetary policy not have the effects? And in a way, this goes back to what Keynes said. In a deep downturn, it's like pushing on a string. That you can, monetary policy can restrain investment by not making credit available. But if you, what we did basically is gave money to the banks to lend, but they weren't particularly interested in lending to anybody except the Fed. So you had money going from the Fed to the banks and then banks back to the Fed. Well, that's not going to stimulate the economy very much. The banks got a little bit of money out of it because they were making, money. We passed a law, I forget what year it was, where for the first time we are paying interest on reserves.
Right.
So we were writing checks to the banks, and they liked that. And so in some of this process, there was a transfer of resources to the banks. But in terms of money getting down to the real economy, very little of it did. Part of the reason is in a global economy, this goes back to issues of globalization, you create liquidity, but the money can't, to the extent it goes to the private sector, they can look all over the world and ask, where do we want to put the money? And they're going to put the money in where there's robust growth. And that was the emerging markets back in 2009, 10, and 11. So what our QE did, our quantitative easing, was to create asset price bubbles. It created problems for a lot of the emerging markets. Their exchange rates went up. But the credit channel was broken, and very little of that money went into real investment. So that's the policy. We've been continuing that policy. We in the case of Europe, they've even gone further. They've gone to negative interest rates. A long time people said the problem was the zero lower bound. You can't lower interest rates. If you could only lower interest rates then to below zero, then the economy would recover. Well, Draghi and Swiss National Bank and Japan said, well, zero is not a magic number, and they are paying negative interest rates. And what has been the effect? Actually, in some cases, lending has decreased. The idea that it would be a solution is actually fairly absurd, because we lowered interest rates from 5% down to zero, and actually in that period, investment as a share of GDP actually went down. And now thinking that going from zero to minus 0.5%, or 1% even, it's absurd that would stimulate the economy. And I don't know if you saw the headlines in the FT this morning. Finally, the G20, after all these years, are now saying it's clear monetary policy is not going to work.
Okay, I'm going to stop letting you be modest
about
this. There is also something else going on. And Joe and I actually wrote an article in 1986 that said, the next time you need monetary policy, you're not going to have it. And the reason is, I think if you think properly is not a surprise. There is very substantial evidence that firms do not respond and households do not respond to interest rate changes over the ranges that we see historically. People have looked for interest rate effects statistically, and they've never found them. What they seem to respond to, and I appeal to you in your business careers, is perceptions of risk. That if there's risk out there, since you want your money back, and that's 100%, the difference between 5 and 3% on top of that is not what makes the difference. In terms of the ability of the economy to bear risk, given that financial markets aren't perfect, you have to build up an equity base as a company. So it takes a lot of time, and that's why the recoveries from traditional recessions are so drawn out as firms build up their equity bases. Now, it used to be in the United States, we had a law that said you could not pay interest on demand deposits. And we had a practice where we never decreased demand deposits. The monetary policy always increased demand deposits. If you think about what those demand deposits therefore represent is, they are permanent, zero-cost financing for the banking system. It's a tax on depositors, and it's a subsidy to the banks. And that is a very powerful form of non-dividend paying equity. It's a TARP without ever having to pay it back and without ever having to pay interest on it, that the Fed just controlled by expanding or contracting the money supply. So if you look at monetary policy in the days when we had that equity injection power, it was extraordinary. In 1966, they contracted the growth of the money supply from essentially 7% to 2%. In 1967, when the Vietnam War was ramping up as rapidly as possible, nominal GDP growth fell by 3%. That monetary policy was unbelievably powerful, and you could see it in the regression results. Once you take away that silent, invisible TARP system, monetary policy doesn't seem to work. And it happened to Alan Greenspan's great good fortune just when he took over the Fed. So he was moving the money supply all over the place. And nominal GDP just kept growing because this was a car that was very hard to drive. Just as he got into the driver's seat, they disconnected the steering wheel from the wheels. He's moving that steering wheel all over like my daughter at Disneyland in the cars. The car stays on the road, and he thinks he's a genius. But when they need that power, that is not there. And actually, if you looked in that era and you looked at the countries that did not have this tax and subsidy system, monetary policy is much more powerful, both on the contractionary side and on the stimulative side, than it is in the countries that don't have it. So in addition, and just as this structural crisis takes over, we do a market fundamentalism-based reform that eviscerates the power of monetary policy. And as long as things
let me ask you guys about a different kind of policy.
Can I just mention one thing? Because it was so eviscerated, the economics profession came up with a new theory. And they said, okay, money supply doesn't matter. It's the interest rate. Okay. And that was very easy for them because it's what we teach in standard price theory. But the point is, the real interest rate has, as Bruce said, very little effect. You know, we've had minus 2% interest rates, and investment is actually, as I said before, as a share of GDP, is lower than it was under normal times. So the economics profession sort of gave an out to the central bankers by saying, don't worry about the fact that money supply doesn't work. Here's another tool, just focus on the interest rate. It turns out that tool also doesn't work. And by focusing on it, they really let us off the rails.
Well, let me talk about another tool that maybe you'll tell me does work or doesn't, which is fiscal policy. If what we needed was to reset long-term expectations, we've got a whole family of tools in fiscal policy. If you want negative interest rates, it's called an investment tax credit. There are lots of things you can do. What about fiscal policy? Should we have used it?
You're asking the right. I mean, I think you need to use fiscal policy. And let me say, even for people who worry about the size of the deficits, there are two answers. One of them is
that's one of the three of us.
Yeah.
But I do.
You're very polite.
But he is wrong.
But if you do, there's an important principle in economics called the balanced budget multiplier. If you increase taxes and you increase spending in tandem, and you choose your taxes right, and you choose your expenditure right, you can really stimulate the economy right. So a lot. So there are ways of stimulating the economy through fiscal policy that don't actually even increase the deficit. But one of the reasons that I'm not very worried about the deficit is that I take, there's in Europe there's a big debate where Germany keeps talking about the Schwabian housewife, and I know it's a little sexist, but in Europe they're not so politically correct.
Well, but they could be male housewives.
We'll focus on Joe. We'll focus on Joe's story. We'll come to yours later. Okay, Joe.
So the point is, Angela Merkel is trying to tell the story that you can't spend beyond your income. And I keep saying the right metaphor is a corporation. A corporation has a balance sheet. It has assets and liabilities. If you borrow to buy productive assets, then your balance sheet is strengthened. And one of the great things about America is that we've underinvested in the public sector. So we have very high return investment opportunities. The cost of capital is negative. The real cost of capital is negative. And so it's very foolish not to make the investment. So we have, at least at the margin right now, lots of opportunities.
But coming out of the crisis, what should we have done in fiscal policy? Because in the U.S. and in Europe, policy actually got tighter in the near aftermath of the crisis. What should we have done?
Well, we should have had an expansionary fiscal policy, and it could have taken on many different forms. As I say, I would have said, identify what you think of as the major social problems, and we may differ, but
we're going to differ.
We're all going to differ.
But the political process can do that, whether it's inequality, climate change,
corporate taxes,
underinvestment in infrastructure. Yeah. There's a wide variety, and I think that actually, even if we disagree in the details, I think we could arrive at a compromise fiscal expansion program that would have, say, on net, the whole program as a whole would be, the stimulative effect are so large that even if we are somewhat critical of one piece or another, our economy is going to be better now, and our economy is going to be better in the future. So,
I agree, and I want us to do that together at the end, but I want to give you a shot on fiscal policy.
Okay.
Should we have used it more? If so, how?
No, I think very differently. I think one of the problems, and I'll just do the quick math for you, is that the average savings rate in the United States for households is about 4%. The top 20% of households, depending on who you believe, probably save about 20% or 15% of their income. And they have between 40 and 50% of the income. That by itself is essentially a savings rate of something near or over 10%. If the overall savings rate is therefore 4, it means the bottom 80% of households are saving 6 to 8% of their income a year, which means since they've got, say, 60% of the income, that they're spending 110% of their income every year at the moment. What does that mean? You give them a tax cut that's temporary, they're not going to spend it. That they are in, because of these structural changes, a permanently difficult situation. I think when you think that you're going to do infrastructure and everybody's kids are going to spend 6 weeks learning to be heavy equipment operators, and they're going to build all these roads in the short term, and then they're going to go home and do whatever they were doing before, just doesn't make any sense. So I don't think you're going to do well with short-term attempts to sort of fill this gap.
What about structural?
Well, I think you've got to do structural changes. And I think one big change in particular, because I think that the problem is not with the economics that Joe's embraced, but with the nature of the people who implement these government policies. One of the reasons I think the public sector is so starved is they haven't spent the money they've gotten particularly well. So I think the big thing you have to do is you've got to have a massive earned income tax credit. So you work for 1,000 hours at $9 an hour, you make $9,000 a year, you will get $18,000 in a tax refund. It supports work, and it keeps the money out of the hands of the government bureaucrats, and it is a permanent change that will make up for this extraordinary consumer deficit. And if you want to have a program of infrastructure improvement, make it a long-term program.
Absolutely. I
Don't
completely
make
agree with
it a
that.
short-term
I want to come back to this toward the end.
adjustment.
'Cause I think this is practical. I completely agree with what you said. Long run.
Boy, this
run
is
first.
dangerous for you.
So let me take you to the third question here about populism. So we have a period of very slow growth in most of the industrial world. And at the same time, we're seeing the rise of populism. We have Trump and Sanders in the United States. We've seen populist leaders in continental Europe as well. Is there a connection there? And what do you think the sources, economic foundations of populism are? And what can we do about it?
So I think, both Europe and the United States are facing the underlying structural problem that Bruce began with, that has led to one of the factors that have led to increasing inequality. And each country, Europe and America, have particularities. So in Europe, I think the Eurozone has made things much worse. So whenever I think about our problems, I just look across the Atlantic and say, well, at least we didn't make that mistake. So but the manifestations of this are that no matter what your statistic you look at, those in the middle are not doing very well. Those at the bottom are doing worse. And that a disproportionate share of the gains have gone to the people at the very top.
And there are no villains in that. That's the way this transformation has played out.
And so you could have leaned against the wind if you had done the kind of earned income tax credit that Bruce talked about. You could have leaned against the wind.
With the IMF printing the money to relieve the international
so there are
imbalances.
ways that you could have, as I say, you could have stopped these forces, but you could certainly have leaned against the wind. Instead, I think we leaned with the wind, and the magnitude of some of these changes are really quite dramatic. There was a study that came out by Ann Case and Angus Deaton, who got the Nobel Prize this year, about life expectancy among white males who have not graduated from college actually going down very dramatically, a kind of change in health that you had. The kinds of times you've seen that kind of thing was the dissolution of the Soviet Empire, the fall of the Iron Curtain, and a complete breakdown of society. So very symptomatically, very disturbing. So to me, on both sides of the Atlantic, there are these underlying forces. We haven't responded to it effectively. And in a way, whenever anybody says the country's going great, it reminds a large part of America, well, it's going great for someone, but not for us. And it's a little bit like the problem that India got about 11 years ago when the government was running for office, and the slogan was, India shines. And they got defeated because the view was it was shining on about 3% of the population, and it wasn't shining on the rest. So, these kinds of campaigns, it's very difficult because when you say things are going well, you're just reminding people that going well for somebody, but not for us.
Populism.
Well, but look, the other thing is that almost all the good statistics that you hear, like the unemployment rate, are phony. And Janet Yellen knows they're phony. So if you look at the unemployment rate at 5, the fact is that the last time there was a good labor market, which was in 2006, basically.
That's when we had a Republican president, right?
You keep telling yourself that. The labor force participation was 3.5% higher as a fraction of the population. But labor force participation as a fraction of the population between 60 and 65 was 3.5% higher. Since that's about 70% of the population that's in the labor force, that's an extra 5% unemployment that has just disappeared from the numbers. But it's very real out there, and it's people who are long-term discouraged. So now you're not at 5, you're at 10. If you look at people who are working part-time for economic reasons, because they can't get a full-time job, that number is 2% above where it was in 2006. That's 12% relative to a good labor market in 2006. A 12% unemployment rate compared to a 4 or 5% unemployment rate. So the notion that we're at 5% unemployment and that's, a satisfactory thing is just flat out wrong.
But you're not suggesting the Fed can bring those people back.
No, I don't think. Look, I'm a big structural change guy, right?
No, but symptomatic that we're not at full employment in a meaningful sense is the fact that if we had a tight labor market, you would see average wages rising, and they're just flat. So that's the sense in which the Fed knows that things are not really back to normal. There have been a lot of changes in the labor market, and so people are, trying to understand what is full employment. But there is actually a natural symptom, which is when markets get tight, wages start to rise.
Let me come to solutions, because I do want to open up for people to ask you guys questions. So you mentioned the EITC. This is something I think we all agree on. I've certainly written on this. We need a massive expansion of the EITC. It's a family program. It's not a work program anymore. It rewards kids. It doesn't reward work. And I think we could do a lot on the tax system, at least would be in my favorite list. And if we did infrastructure long term instead of shovel-ready, targeted, timely, temporary.
And my view back in 2008 was that the crisis was going to last a long time because it was the structural problem. So my view was, you have a lot of time.
Your view back in 2002 was that the crisis was going to last a long time. And you were right, but not till 2008.
Okay. So do you guys have any other elements of a solution you want to throw out?
I'll say something else that I think is a huge source of dissatisfaction. I don't think anybody trusts the government to be a solution. That, you look I know you do.
But you always have.
But you always have. But you look at how much money the government has been spending, state and local government in particular. It's been collecting more taxes. It used to grow at 3 to 4% a year in real terms. They've made all these promises that have impoverished them. So they're collecting the taxes and providing lower quality services. So I think you've got a big problem with just saying, let the government spend money. I think if you're going to do it, either you want to do it with the earned income tax credit to take it out of the hands of the government, or have dedicated structural programs that are beyond the reach of the vote-buying tendencies of the states that realistically, and I think you have to take this into account, people in New York, we know, are more dissatisfied than people in Texas because they're all leaving New York for Texas.
I could talk about that, but I won't. I'm going to open it up to all of you to ask these guys questions. If you raise a hand, please wait for a microphone, and I'll repeat your question for the benefit of people in other rooms.
Thanks for a great discussion. James Torelli from 96. It's not hard to imagine, and I'm really curious about the probability you'd put on this scenario, that with central banks around the world now holding the amount of their domestic sovereigns that they do, that one solution for highly indebted economies is to figure out a trick to make that central bank held debt just disappear. What do you think the odds of that happening are? Is there something structural that could prevent it? And if it does, and if it were followed by some sort of massive printing or federal expenditures that were directed, do you think that's an actually positive outcome or highly unlikely?
Mention the question for everybody who's remote. So central bank balance sheets are large with sovereign holdings. What if the central banks effectively ran those off or canceled them? Just a quick footnote, so-called helicopter money strategies are also related to that argument. I'll bundle it all in the question and give it to you guys.
Yeah, can I do the why we're not worried about the debt?
Okay, sure.
You can do this calculation. So a really big federal government deficit is 6% of GDP a year. That leads to a permanent imposition on the economy to support that debt. The typical real interest rate on that is about 2%, given the term structure of government debt.
Right now it's minus.
Right, I know, but we're going to do long term here. 2% of 6% is about 12 basis points. That's 0.1% of GDP. Productivity growth in the United States, that until very recently was the best in the G7 for 10 years, which has never happened before, is sort of 1.5% above per year what it is in these other countries that are not doing so well on average. Well, that's 150 basis points. So when people talk about the problem of the debt and not being able to service it and impoverishing our children, at least except for the distribution of income issues, our children are going to be 1.5% richer every year from the productivity growth, which is also a permanent stream. And they're only going to spend less than 10% of that to support the debt. So I think legitimately neither Joe and I are particularly worried about the debt. Now, I think we also believe that what the central banks do at this point, since they don't have this risk absorption capacity that they used to have, is largely irrelevant to anything.
So can I just
please.
highlight, sort of the conceptual point you raised, a really interesting one. We talk about the outstanding debt, 20 trillion or whatever it is. But a lot of that is being held by a part of the U.S. government, because the Federal Reserve is essentially part of the government. So the government owes money to the government. That's an interesting concept. And that's why in the statistics, actually, they record both the gross debt and the net debt. In terms of this particular issue, you owe money to yourself. Does it make a big deal of difference if you write it off? And the answer is no. Nobody would notice if you didn't tell them. So the world would go on just like it did before. So the answer is whether you write it off or not is irrelevant. And if there are some people whose blood pressure gets up if you write it off, then I say don't write it off. But if there's some people who like to look at that gross number and you say I can get that gross number down by writing it off, and that makes them feel better, I say go ahead and do it.
Okay. Yes, ma'am. There.
Hi, Leslie Wayne, class of '81. Professor Stiglitz, when you were talking about the low interest rate policies, monetary policy, with the idea that the banks were going to lend, and then the banks, of course, didn't lend and didn't stimulate the economy, was there anything that the government, aside like job owning, or is there anything that could have been done to encourage even more the banks, or put some pressure on the banks to do what was expected of them, or what they'd hoped they would do? Yeah,
there were actually a couple of things, and one of the is to go back to understand that there's the banks are important intermediaries between monetary policy and the real sector, the real economy. So one thing, for instance, has a little affecting some countries is that you say access to the Fed window is only going to be given to banks who lend to SMEs. So you link the lending to the uses to the fact that you're actually lending to a group of firms who are really tight. The large corporations are sitting on trillions of dollars of cash. It's the SMEs that are a problem. Secondly, you could have had a further restraint and say, and actually the Fed has a little powers to do this. You say, look at lending to buy fixed assets doesn't stimulate the economy. It creates asset bubbles. What we want to do is lending for new productivity, like investment goods. So again, you could have put some restraints. These are all imperfect, and people will circumvent, but I also think that when you put those constraints, on average, they have some effects. Thirdly, you should go back and ask the question that Bruce asked. how do we make the banks actually healthy so that they are willing to lend? And secondly, how do you reduce the risk? And one way of reducing the risk is what the SBA has done, a Small Business Administration. What they do is they take some of the risk off of the loans. Not enough to cause a moral hazard, but enough to stimulate investment. In particular, there are some ideas of risk sharing where you say the government will undertake some macroeconomic risk. If the economy is weak, we will absorb some of that downside risk. But if the economy is strong and your firm does badly, then obviously you've made a misjudgment. So you could get more macroeconomically sensitive risk bearing that would encourage the lending. Just one more thing. TARP was focused on systemically significant banks. But a lot of the big banks do much less of the SME lending than the smaller banks. And all the smaller banks together are systemically important in terms of the macroeconomics. And so by not focusing on them, allowing actually hundreds of them to go bankrupt, we actually put a constraint on the healthiness of the part of the banking sector that might have supported the SMEs to do their job.
I want to step in with a question from one of the other rooms, just to be fair. What about the impact of the $15 minimum wage, short-term and long-term? Good idea, bad idea, consequences?
Oh, I mean, look, if you do, the reason that we did $18,000 for the $9 an hour, 1,000-hour worker is because that's $27,000, which is very close to what you get with a $15 minimum wage and an 1,800 hour a year. If you impose that wage, nobody's going to get hired. Whereas if you can let people be hired at $9 an hour, they're going to get trained, they're going to get hired, they're going to move up the job chain, and it's going to be a much happier situation with the same effect on the income distribution as the minimum wage.
So
I like that answer. I'm
okay,
tempted not to give you a chance, but okay, go ahead.
I think the wealth of econometric evidence, the subject is being studied enormously, and the evidence is that for increases of the minimum wage that we're talking about, say to $15 an hour, $12.50 an hour, the effect on employment is minimal. Some studies have it actually negative because of the income effect. A lot of these people are employed in service sector like McDonald's. People are not going to say, I'm going to stop eating at McDonald's if they raise the price by a few cents. They'll have a little effect, but you're still going to have the same amount of employment. So I think, there is a number that is high enough where Bruce's concerns kick in.
Well, but the composition, Joe, of employment changes at $15 versus $9.
But surely, isn't it the case, Joe, that if Bruce is accomplishing the same income gains for people with an EITC expansion, that's got to dominate a minimum wage? Because even if some people lose their job under your scenario, isn't Bruce's a better idea?
I think you should do both. So I think you should have $15 minimum wage and
okay, we're getting
okay.
All right, so I've got one more
I don't think it's either or. I think it's both and.
Let me do one more from another room, and I'm going to turn back to this room, and we'll keep bouncing back. So we talked a lot about stimulus, fiscal policy. What about the regulatory environment? Is overregulation a problem structurally, financial industry, or other factors?
I think the issue always is the right regulation. I mean, obviously, we had under-regulated some of the risk-taking. We under-regulated some of the predatory lending practices. Some of this is enforcement. And, there are issues. There was massive fraud in the financial sector, and it was only effectively uncovered in the large number of suits that happened after the crisis. We had market manipulation of LIBOR, Forex, obviously undermining confidence in the banking system. We should have had stronger regulations if we could have implemented them. I think, so in my mind, in each of the areas, one wants to identify what are the reasons why the markets aren't delivering in the way that we want, and what are the best regulatory systems for getting there?
Okay.
Okay.
Let me do
jump
this
in on
one.
this.
You're not going to get those regulatory systems, Joe. The best
We
example.
have,
Well,
reasonable-
hold on.
Bruce's turn.
Let's
There you go.
do a country with both a good government and extensive intervention, which is, of course, Japan. The stories we tell about Japan are ironically stories that have nothing to do with the Japanese reality. We talk about zombie banks. We talk about demographic problems. If you compare Japanese growth to U.S. growth, pre and post 1990, which is when the lost decades in Japan start, hours worked in Japan pre-1990 grow 1.5% more slowly than hours worked in the United States. Hours worked post-1990 grow 1.5% slower than hours worked in the United States. It is not an hours worked problem, which means it's not a demand problem. Productivity growth in Japan pre-1990 is 3% higher per year than in the United States. Productivity growth in Japan post-1990 is 0.5% lower than the United States. That's a 3.5% change. What is driving that change? There is a deep ideological commitment in Japan because they think their imports are crucial food and raw materials, and their exports are dispensable, to have a powerful manufacturing sector that drives exports. And they are taking all the management talent that is responsible for productivity growth and focusing it on a dying sector. And that is a disaster that is not close to getting corrected. It's as if they decided they were going to dominate the world economy by focusing on agriculture. And now I'll tell you a story about how easily they adapt to that, because these are the people making policy. So I gave that speech in Japan, and I got to have dinner with the prime minister, who I guess had been briefed on my showing this data. Because he looked at me and he said, you know, we're finally learning to export food. And all I could think of was, you know, you really got the wrong end of the stick.
Yeah. All right,
And I think you're dealing with those environments when you regulate and try and achieve these ends.
Let me come back to this room for quick. Just to let you know, while I don't like deficits generally, we are going to run a deficit. We're going to run this session over, so we do have time for more questions. I'm going to take one from this room. Larry?
Could you drill down a little bit on the Larry Lawrence class is 71. Could you drill down a little bit on the income inequality issue, and between the sort of Piketty thesis on one hand and his critics on the other, who say you haven't really added back transfer payments and other kinds of things? I mean, how big a problem do you think that is, and,
Let Joe
and what
start
do you
with this,
see?
because he's written widely on
What do you
this
see as viable solutions to it?
Joe, why don't you take it
Well,
first?
so first,
Questions about income inequality, how bad is it, Piketty versus other theses? Joe.
it's not only income, but it's also wealth inequality. And so, you know, the data on wealth inequality are striking, that and fairly robust. That is to say, almost all the studies come up with the same conclusion that you know, and it's not only the United States, it's global, that the fraction, you know, the top 1% has about 40% of the wealth. And that number has increased dramatically. So those are the two, high levels and increased dramatically. Market wage, also very clear that there's been a very large increase in inequality, and that and very little dispute over that, and that. So the one area where there is some dispute has to do with some very difficult calculations, which have not been done right, on how you value certain kinds of government benefits. So if the biggest increase in benefits have been healthcare benefits, Medicaid, Much of that increase is as a result of higher cost of living increase for higher CPI for healthcare, as we measure it. And there are a lot of disagreements about what right way to measure it, and that's one of the reasons that's so difficult. So most of that is not an expansion of benefits. It's been just keeping up with the cost of those healthcare benefits. So if you if you adjust for the various factors, it is still the case that we have certainly among the highest level of inequality in the advanced countries, if not the highest, and that it has increased. When you include that, it may not have increased quite as much as otherwise, but that's basically the dispute is over that. How do you value that Medicaid?
And where did the change in inequality come from? What economic
Well, so
forces?
that's where there is also a dispute. There is one school of thought that emphasized what they call skill-biased technical change. That technical change increased the value of people with high skills relative to low skills. And that has some effect on the interpretation of the labor market, but it doesn't explain two facts. One of them is actually since about 2000, even skilled wages have not done very well. And secondly, the average wages, which was the average of the skilled and unskilled, has done very badly. And a reflection of this is before 1973, 75, 80, increases in productivity and increases in average, median, compensation, whatever measure, move in tandem. And beginning somewhere in the 70s, their average wages, median wages stagnate, and productivity continues to grow. So it's that gap that has opened up. Piketty doesn't say anything really about that, because Piketty is talking about how it is that the share of capital has gone up. And here, Bruce and I emphasize another factor, and that is the increase in market power. And there may be many explanations, including the one that Bruce talked about. Some people talk about network externalities giving certain industries more market power. The Council of Economic Advisors and just put out a report. Just wrote a report about a concern about the evidence of increasing market power in different sectors. So there is an increasing, I would say, sentiment, certainly, that side of the story has a lot to do with what was going on. Piketty's explanation has one more problem, and that is he makes one critical analytic mistake, and that is the distinction between wealth and capital. So they sound the same, but
housing,
the different real estate, land.
Yeah.
So the price of land can go up, but there's no more capital. There's no more productive capital in the economy. And the evidence actually is that for the United States, the capital output ratio, productive capital output ratio, has been going down, even as the wealth income ratio has been going up. And there are, the general explanation of that is the growth of rents, the capitalized value of rents, which are land rents on the one hand, and monopoly rents.
Can I do a specific example that may illustrate what's going on? And let me talk about an old industrial company, John Deere. Used to make tractors. 80% of what they sold was the cost of the tractor. Now what John Deere offers is financing, and that's done locally. So if you're in a region where John Deere is 90% of the tractors, they know all the farmers. They're going to be the ones who control the lending market, because if you come in and make an offer to a John Deere customer to finance their tractor, John Deere is going to know whether they're a good risk or not. If they're a good risk, John Deere is going to match your offer and keep them. If they're a bad risk, they're going to say, that's a great offer from Kubota. We suggest you take it. And Kubota is going to get 90% bad debt. So that is a market that John Deere will dominate locally. Secondly, there's just ordinary maintenance, which is a much bigger part of these tractors. And if John Deere has 90% of the tractors in that region, they're going to be able to fix it really quickly. Third thing is that increasingly the tractor companies do software that is locally customized. So those tractors now increasingly have nobody in them, and the harvesters have nobody in them. And that's a fixed cost by region. So if it's 90% Deere tractors, I don't care what price Kubota offers, you're probably going to have to buy a Deere tractor. And finally, there's a big secondhand market, which is the network effect locally. So now Deere has a conscious strategy of dominating regions one at a time. They're currently focused on Brazil. Caterpillar doesn't seem to understand the mechanics of this so well. Deere's profit margins have gone through the roof because now if Kubota or AGCO try and go in and offer tractors at discounted prices, Deere doesn't have to match the price. They've got all this infrastructure that gives them a huge advantage. You see the Deere margins go through the roof, and you see something else, that price competition in bad times has disappeared. So in 2000, their tractor sales fall from 11.2 billion to 11 billion, and their margins go to zero because there's price competition. In the crisis in 08-09, they fall from 26.2 billion in sales to 21 billion in sales, and their margins fall from 19% to 8.6%. It's just a different world when you've got local service markets that can be dominated. Oh, I don't think so. I mean, I think you care much more about income than wealth, because that's what people live on, and actually most of real wealth is capitalized human income. So I think what you want to do is fix the income problem that arises from this. And also, by the way, when Deere has that infrastructure, the guy who runs that local infrastructure well, using relatively low-cost labor for most of the jobs that are involved, is going to get paid a lot because there are going to be differences. And so you're going to see big changes in individual income levels also. And I think that at the ground level is how this plays out. And I don't think you're going to fix it with outside regulation because these are natural monopolies.
Okay.
So can I just say one more? The one part you really do care about is the intergenerational transmission of advantage. And so that's gotten worse. And that's where there is public policy, like public education, or
and that's worked really well.
Okay, gentlemen. Okay, so I've got one more question I'm going to take from the other room. Then I'm going to give these guys a lightning round to sum up. So, Bruce, you said there are no villains in getting us where we are, but voters seem to feel otherwise. They're pointing to banks and politicians for getting us there with a throw the bums out move. Are they villains? Is somebody responsible for getting us here?
Yes. Look, the public discourse is always about villains and heroes. I'm a good guy and you're scum. And we're very comfortable with that version of the world. And that's why when you read the public discourse about this, whether it's, I don't want to say the word that begins with I, Donald Trump, or somebody else, that is just baked into the way people talk about things. You don't like to think of impersonal forces. But the reality is there are impersonal forces at work here, and to the extent that you personalize them, you're going to make bad decisions. And here I do want to do a cautionary note. Inequality is a big problem, and Joe and I agree you want to fix it. We disagree on how. Most of the time when people try and fix it, it works out really badly. So my last word is, think Venezuela.
No.
Okay, before we go to Caracas together, I'm going to do a lightning round. Let's make America great again, gentlemen. Joe, sum up. What's your view of what we need to do from here?
Well, I think the most important thing for addressing, you might say, inequality is making sure we have full employment, really full employment, not the 4.9%, because once you have
12%. 12.
Yeah, and not the official 4.9.
Right.
Because when that happens, you start getting wage pressure, everybody gets a job, and that is the single most important. I think these other measures are also very important. I think there are some countries that have succeeded in achieving both growth with more equality. I think the evidence is that you can, the two are complements, in fact, and that we are actually paying a high price for our high level of inequality. So I actually think that there are measures, a lot of measures, no magic bullets, but there are lots of things that we can do if we do it thoughtfully. And if we don't do it, I think the kinds of what we're seeing in some of the political campaign will become a regular feature of American politics.
Bruce.
Okay, I would like to stress one thing that may not be apparent here. Joe and I absolutely agree on the economics of this situation. What we disagree on is how effectively certain government institutions are going to operate to correct it. And I think that there you have to be really careful of one thing. You have to deal in policy terms with the hand you're dealt. We are not all suddenly going to become Swedish. So what works in Sweden is not going to work in the United States. And you have to deal with that. And I think in doing these reforms, why you want the simple structural reforms that will go a long way to generate consumer demand and full employment, you want to keep the hands of the interfering government institutions off this stuff as well as and as far as you can.
I like that. So it's a good place to stop. It's before you all.
That's why he's Dean.